Markets anxiously awaiting the May jobs report out Friday, which could give us insight on where the Fed stands on its policy and how strong economic growth is. Our next guest is decidedly not optimistic about what we could hear, saying even a broken clock is right twice a day, unless that clock is the Federal Reserve. Simplify Asset Management Chief Strategist Mike Green joins us now. Mike, great to have you with us. So you sound pretty down on the Fed right now. What are your concerns? I mean, that I was reading through the notes, I thought was really interesting. That's the notion of zombie companies. And we talked about that on the show a couple of years back, even before the pandemic. But now this seems to be an issue that would come back to the fore with rates rising.
Yeah, I think that's absolutely correct. I think you have two separate issues. One is that the Federal Reserve is basically been backed into a corner where it's perceived as being having to do something. It got the transitory inflation narrative wrong last year, or more accurately, I would say that they didn't describe it well. Convinced people it was basically a 2 to 3 months phenomenon as compared to a 2 to 3 year phenomenon as we worked the difficulty through the system of supply chains being disrupted. And what we're looking at today is a system that requires investment. And higher interest rates do the exact opposite. So instead of investments in infrastructure to improve our ports, instead of investments in inventory, instead of investments in onshoring production, we're being forced to divest. And that's the world that we're creating under the Federal Reserve's policy.
You say roughly 25% of the Russell 3000 are zombie. So how do you view how that impacts the rest of the market?
Yeah, so it actually is a relatively small percentage of the market cap of the Russell 3000, right? So the Russell 3000 is about $43 trillion in market capitalization. The total market capitalization of the roughly 700 zombie companies in the Russell 3000 are somewhere around 1.7 trillion, so roughly 3/5 the total market cap of Apple Computer. The problem is that they employ 16 times as many people. And so what we're talking about doing is taking companies that are incapable of maintaining their operations without refinancing, and we've shut down their access to financing. As these companies encounter increasing distress, we're already beginning to hear stories of even the largest companies beginning to encounter difficulties in their labor, where Amazon has announced that they've overexpanded, for example. That doesn't begin to compare to the challenges that many of these companies that are unprofitable or unable to service their debt are facing as we enter this new regime of higher interest rates.
So it sounds like you're investing for a recession scenario. You think a recession, a strong recession, is likely at this point. So what does your portfolio look like? I see that for instance, you don't like these buy now, pay later stocks, which have already contracted quite a bit.
Yeah, so within my portfolios, I just want to emphasize that Simplify is an ETF firm we launched in September 2020 to take advantage of a change in regulation that allows traditional exposures like U.S. equities, as you might see in the IVV or the SPY ETF, and adding the derivative overlays for downside protection or to augment income or returns. We've grown rapidly from that point, but our portfolios are ultimately typically reflective of underlying market exposures with a derivative overlay. In terms of the portfolio that we're discussing today, we recently launched FIG, which is a macro portfolio that combines many of the underlying exposures that we created in our ETFs. The underlying exposure combines an equity exposure that we've accessed through a in-the-money long-dated put or call structure, that allows us to have exposure to the S&P 500 while at the same time limiting that exposure. So roughly a 60% weighting to the S&P, but ultimately only about 8% of the portfolio is at risk under that structure.
Okay, we are out of time, Mike, so I got to leave it there. I'll get your thoughts on a firm another day, maybe. Mike Green, appreciate it. Mike Green of Simplify.
Thank you very much.
All right, Bonawyn, are these views too strong for your taste?
They're strong. Not too strong. I think he makes a lot of good points there. He also mentions the household expenditure on food and energy and how that should actually be looked like through a different prism. So I think he makes a pretty compelling case. Me being an options guy, I do like the equity exposure through options, and they're deep in the money. So even if you get a spike in volatility, which Leaseman and everybody else has kind of said that's a real risk, that's kind of dampened. So I think it's an intelligent approach.